What if I told you there's a way to buy an investment property without showing your tax returns or your W-2s? Sounds too good to be true, right? Well, it's not. It's called a DSCR loan, and it's perfect for investors who want to move fast without the paperwork hassle. No tax returns, no pay stubs, no employment verification. The lender only cares about one thing: does the property make money? I'm Matt Jolivet, president of Associated Mortgage Brokers and a licensed loan originator with over 25 years in the mortgage business. I've been doing these DSCR deals across Oregon, Washington, and Idaho since its inception, and I see exactly how lenders price them every single day. In this video, I'm going to walk you through exactly what a DSCR loan is, how lenders calculate your rate, real examples with actual numbers, and why this might be the perfect loan for your next investment property. Section 1. What is a DSCR loan? All right, quick refresher. DSR stands for Debt Servicing Coverage Ratio. Fancy name, simple concept. Instead of digging through your tax returns or asking for pay stubs, the lender looks at one thing: does this property make money? Now, you're going to pay a bit more than a standard conventional investment loan, but we're not talking crazy money here, usually not much higher in rate. Here's the key thing to understand, and these are considered business loans. The lender treats your rental property like a business, which is actually pretty cool. You can refinance and pull out cash with this product, but here's the kicker. You have to provide a statement showing what you're using those funds for, and they must be used for business purposes. So you can't just cash out and buy a boat, but if you want to buy another property, renovate, or expand your real estate business, you're golden. Here's the math. DSCR equals monthly rent divided by total monthly payment. Your total monthly payment includes everything: principal, interest, taxes, insurance, HOA fees, the works. So let's say you've got a rental bringing in $4,000 a month and your total payment is $3,200. That's $4,000 divided by $3,200, which gives you $1.25. That's solid. The property makes more than it costs. If the rent is $3,200 and the payment is $3,200, you're at 1, breaking even. If the rent is $2,900 but the payment is still $3,200, now you're at 0.9, losing money every month. And here's where it gets interesting. That number directly affects what rate you're going to get. Section 2, how your rate gets set. Your DSCR rate comes down to 3 big things. Think of them like levers you can pull. Lever number 1, your cash flow ratio. If your DSCR is 1.25 or greater, the lender's thinking this property pays for itself and then some. You get their best rates. If you're sitting at 1, now they're like, okay, this breaks even, but what if rent drops or repairs come up? Your rate goes up a little bit. If you're under 1, the lender sees red ink every month, so they'll still lend to you, but they want higher rates, bigger down payments, and more money in reserves to cover the shortfall. Lever 2, your credit score. 740 or higher, you're golden. Great pricing tier. Around 680, still doable, but your rate's going to be higher, or they might cap how much you can borrow. Lever 3, how much you put down. 25 to 30% down. Lenders love this. Less risk for them, better rate for you. Only putting down 20%, your rate bumps up, and you better have a strong cash flow ratio to make up for it. In some cases, if you've got a great credit score and a DSCR of 1.2 or higher, you might even get away with just 15% down, but that's the exception, not the rule. Section 3, the prepayment penalty reality check. Here's something most people don't expect. Almost every DSCR loan in our area comes with a prepayment penalty. Lenders want you to keep this loan for 3 to 5 years minimum. Why? Because that's how they make their money. 5-year prepayment penalty, you get the best rate they offer. Want a 3-year prepayment penalty or want to buy it out completely? Great. They might refinance in 2 years and we do not make as much money, so your rate goes up. It's a trade-off. Flexibility costs you money. Section 4, real examples from today's market. Just to be clear, these are example rates to show you how different scenarios get priced. Your actual rate will depend on your specific situation and current market conditions. Example 1, the sweet spot deal. Let's say you found a duplex in Portland. Loan amount, $600. $600,000. Monthly rent, $4,500. Total monthly payment is $3,600. DSCR, 1.25. Nice cash flow. Credit score, 740. Down payment, 25%. Prepayment, 5 years. The lender sees this and thinks low risk, good profit potential. Your rate, 6.99% at no points. Example 2, the break-even deal. Now picture a rental in Boise. Loan amount, $700,000. Monthly rent, $4,200. Total monthly payment, $4,200. DSCR, 1. Breaking even. Credit score, 700. Down payment, 20%. Prepayment penalty, 3 years. Same lender is now thinking higher risk and they might bail in 3 years. Your rate, 8.249% at no points. Example 3, the negative cash flow deal. Here's a tricky one. Maybe a short-term rental in Bend. Loan amount, $800,000. Monthly rent, $4,000 based on average rental data. Total monthly payment, $4,400. DSCR, 0.9, losing $400 a month. Credit score, 710. Down payment, 30%. Prepayment penalty, 2 years. Okay, now the lender's thinking, this is bleeding money. Plus they want out in 2 years. You can still get the loan, but your rate is 7.99% at no points. And they'll probably want a bigger cash reserve. All of these scenarios were priced as of mid-September 2025. Section 5, why lenders even do this? So why are lenders comfortable with these deals? Simple math usually works. When properties actually cash flow above 1, these loans perform really well. Even the negative cash flow deals aren't that scary if the borrower has skin in the game with a big down payment and reserves. Plus, they're pricing in the risk. Higher risk equals higher rate. It's not personal, it's just business. Section 6, why this works great in our area. Here in the Pacific Northwest, DSCR loans are everywhere, and for good reason. In Portland or Seattle, maybe your rental income looks great, but your tax returns don't tell the whole story because of depreciation or other write-offs. DSCR loans don't care about that. In places like Bend, Boise, or Spokane, short-term rentals are huge. Regular banks hate Airbnb income, but DSCR lenders will use market rent data or even AirDNA numbers to qualify you. I work with lenders doing these deals all across Oregon, Washington, and Idaho. Bottom line, this isn't rocket science. Strong cash flow plus good credit plus decent down payment equals better rate. Weak numbers or shorter prepayment penalty equals a higher rate. The more you can strengthen those 3 levers, the better deal you're going to get. If you've got a property in Oregon, Washington, or Idaho and want to see what your DSCR loan would actually look like, click the link in the description below and you can schedule an appointment with me directly and I'll run real numbers for you. No BS, just facts. And if this helped you understand how these loans really work, hit that like button. Make sure you're subscribed for more real estate finance breakdowns and drop your questions in the comments. Everything you need to inquire is on my website. Links right there in the description. I'll see you on the next one.